Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 stocks to consider buying before their upcoming earnings releases. But before we get into everything, remember to subscribe and leave a review wherever you're listening to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into the 3 stocks that are worth considering before their upcoming earnings releases this week, we're going to take a broader market overview and then a look at the earnings picture as well to give more context for what's going on. So big tech dominated the headlines during the last week of July, which was last week, with reports from Apple, Amazon, Alphabet, Microsoft, Facebook, and countless other market movers like Tesla, and the list goes on and on and on. And Wall Street mostly shrugged off what were strong results, once again, that solidified tech's massive earnings power, but the subdued reactions are hardly shocking given the huge run that the market and technology stocks went on heading into the heart of earnings season. We saw investors finally start to dive back into tech in mid-May as the cyclical trade slowed and many of those surefire long-term standouts reached levels that were just a little too enticing to miss out on. And investors shouldn't be surprised if we see some more near-term selling given how quickly that mid-July pullback was wiped out, with the stock going right back up to new highs. So Wall Street could easily take more profits off the table, and we could see another healthy recalibration as some tech names once again are sitting near some elevated technical levels. So despite the possible pullbacks and corrections, the bull case remains strong for the longer term, even with some of the economic slowdown fears and rising price worries and Delta coronavirus fears. The U.S. economy expanded at beyond its pre-pandemic levels in the second quarter with GDP up 6.5%. We also saw data come out last week that consumer confidence popped in July to its highest levels in 17 months, so right before the pandemic. And the earnings picture just continues to improve. So investors with outlooks of a year or more really shouldn't be worried as much about trying to time stocks or worried about buying stocks at new highs, because especially the last 18 months has shown us that trying to time the market is a very, very difficult thing. It can sometimes lead to that dreaded buying high and selling low. And the market, as we mentioned, the market's moves over the last 18 months have really showcased why trying to stay as exposed to the market as possible is often a very beneficial investing strategy, especially for investors and not traders necessarily. So, and we also know that the Fed is offering up its somewhat standard sentiment regarding its eventual rate hikes, which means Wall Street's probably going to be left chasing stocks, returns in stocks for the foreseeable future, because rates are going to remain historically low for really years and years to come, even when the central bank is forced to raise those rates, because the 10-year U.S. Treasury has remained below 3% for nearly all of the past decade, and I can't see that changing anytime soon as they slowly try to lift rates off rock bottom levels in the next few years. With that in mind, Q2 earnings results for the S&P 500 are now expected to climb 88% from the year ago period. Obviously, this is an easier to compare period, but still really impressive growth. And this has gone up significantly in the last couple of weeks alone. We're calling for 22% higher revenues. With the current quarter, like total earnings for the S&P 500 are expected to be $457 billion, which would be larger than last quarter's, which was an all-time high. So just massive blowout earnings, and we've seen some big, huge results from those tech players last week. So on an annual basis, we're calling for about 41% earnings growth this year on about 12% higher revenue, with then expecting about 10% higher earnings in 2022 on about 7% higher revenue, with then another 11% earnings growth in 2023 on about 5% higher revenue. So just continued growth even in 2022 and 2023 for the S&P 500 on top of this huge year of growth we're calling for in 2021. So with this in mind, we're going to take a look at the first of the 3 stocks we're talking about today, and that is Roku, which trades in the ticker that is its name, ROKU. And the company reports its Q2 FY21 results on Wednesday, August 4th. So this upcoming Wednesday. And now we're just going to dive into the stock and see if investors might want to consider it as a longer term play heading into earnings. So the streaming entertainment age is really here to stay in the legacy media world continues to lose consumers in droves. Netflix now boasts over 200 million paid subscribers after a decade of dominance, and that streaming pioneer is now part of a really quickly expanding group that includes some of the biggest companies in the world. So Disney and its massive catalog have had a successful storming into the market, and then its competitors are Amazon and Apple and countless other companies that are all in this space. And quietly behind all of this, maybe not quietly for many, is Roku. And they're poised to keep cashing in, and it really hardly matters which one of these services grabs the most attention or who has the most subscribers or the hottest show. And it's definitely not going to be a winner take all for Netflix or Disney, because often people have more than one since they have drastically different content libraries. But as we mentioned, Roku is poised to grow no matter who's coming out on top, because they have their small plug-in devices that allow users to watch streaming TV content from nearly every service under the sun. And this is how they became famous. They also have tech that's built into smart TVs, and their operating system was the number one smart TV OS sold in the US in 2020 with nearly 40% market share. But Roku really became a Wall Street darling over the last several years on the back of its ability to attract advertisers in the digital age. So Roku makes money by selling ad space across its marketplace and taking a share of streaming service subscription revenue and ad inventory. So Roku now allows marketers to buy targeted ads, promote their streaming content, platforms, and much more. And this is just a booming business as more and more people cut the cord, and advertisers and marketers find it harder and harder to reach consumers in the Netflix age, where people are paying to avoid ads pretty much at all costs. So digital is expected to account for nearly 65% of the roughly $240 billion a year ad industry in the US by 2023. And this is up from just about 1/3 of ad spending only a few years ago. The company has also boosted its ad credentials through acquisitions such as Nielsen's advanced video advertising business. Roku is also exposed to the content side through its own channel that allows users to watch free ad-supported streaming movies and TV. They've tried to bolster those offerings as well recently. So with this in mind, Roku topped our Q1 estimates with its ad-heavy and higher margin platform revenue up 101%. to account for about 80% of total sales. So this is why Wall Street is really focused on that ad revenue. The company also added about 2.4 million active accounts to close with nearly 54 million. And its monetized video ad impressions more than doubled year over year. The streaming TV firm has also destroyed our bottom line estimates in the trailing 4 quarters, including posting 3 straight periods of positive adjusted earnings when Zacks was calling for a loss. So Roku's consensus earnings estimates have skyrocketed since its Q1 release. With its full year 2021 figure, we were calling, before its strong showing, we were calling for an adjusted loss of 37 cents per share. Now we're calling for positive 45 cents per share. And FY 2022 is expected to be 97 cents per share, up from just 33 cents per share. So some massive positivity on the bottom line. Zacks estimates are calling for its 2020 revenue to surge 54% from about 1.8 billion all the way up to 2.7 billion, with it set to add another billion or about 40% more revenue in 2022. So these estimates would mark 5 straight years of between roughly 40% to nearly 60% sales growth for Roku. And the company is also, as we mentioned, projected to swing from an adjusted loss last year of 14 cents per share to positive 45 cents per share this year, and then get all the way up to 97% or 97 cents per share in 2022. We should also note that Roku's balance sheet is strong and it's prepared for further international expansion. And the stock's recent earnings revisions, stagnation, even though it's had lots of positivity since its Q1 results, the last couple months have been more stagnant. So Roku has a Zacks rank number 3 hold at the moment. Luckily, Wall Street is largely bullish on the stock, with 16 of the 20 brokerage recommendations Zacks has sitting at strong buys. We should also note that the stock has soared about 165% in the past year and about 825% in the past 3 years. And like many other growth names and tech standouts, Roku hit new records just last week. And this is after its climb since that mid-May area. And the stock has slipped a little bit since then. In fact, it's actually down about 12% from its recent highs, which is a nice possible pullback heading into earnings for a more enticing entry point. So at around $427 a share as of early Monday morning. The selling has also pushed it right back to neutral RSI levels at 50. So this selling in the last week since it just hit highs could actually be a good entry point for investors, especially if you have a longer term horizon. The stock is also trading at a nearly 30% discount to its year-long highs at about 16.7 times forward sales. So therefore, for investors who are thinking about, as we've continued to mention, not just where a stock's going to be this year, but maybe in 5 years or 10 years, it's certainly worth considering Roku, despite the possibility of some more near-term selling within the market and if they disappoint around earnings. But longer-term investors, as we continue to say, should not be as worried about trying to time a stock that seems poised to grow in a space that's going to be booming now and booming for a very long time. Now we're going to move on to another stock that reports on Wednesday, August 4th, and that is Etsy, which also trades under the ticker that is its name, which is ETSY. Etsy has shined did shine during the early months of the pandemic. This is boosted by people buying everything online. People even bought more masks online from the niche e-commerce site. But the Brooklyn-based firm clearly is much more than a mask seller, which is obviously important. And it was expanding well before the pandemic, and it will keep growing long after that. The company allows individuals, entrepreneurs, small businesses to sell everything from handmade clothing and jewelry to art and home decor and really anything under the sun. It's kind of like a e-commerce version of a really cool arts and crafts fair where you could find lots of different things that you might not be able to find on, say, eBay or Target or Amazon. And this is why the company has been able to succeed in a market that's largely dominated by those big players. The company makes money from transactions and advertising and paid search, and it's posted really strong growth since its 2015 IPO, which includes about 37% sales expansion in 2019 and 2018. So that's before the pandemic, just to give you a sense of their growth. Etsy, which also owns the musical instrument marketplace Reverb, has been growing recently through acquisitions as well. So the firm on July 13th completed its purchase of fashion resale app Depop, which people might have seen commercials for recently, depending on if you're watching, things on streaming. I know my wife and I have seen lots of ads for this company. I didn't know what it was until a couple months ago, but they bought it for $1.6 billion, and it's a widely popular area within the fast-growing retail or resale space. So it's really popular with Gen Z age people buying and reselling clothes online and shoes and all of that stuff. It's a widely popular thing. Etsy's decided to spend $1.6 billion on it. Etsy also then in July finalized its purchase of a Brazilian e-commerce company that people are calling sort of the Etsy of Brazil. So this is just adding to it's now what they call a house of brands that's featuring 4 standalone e-commerce platforms that are then combined to help it compete longer term in a growing e-commerce space. So last year, Etsy's sales soared about 111% to $1.7 billion. This was obviously boosted, as we mentioned, by pandemic buying. Luckily, only 4% of Etsy's overall gross merchandise sales came from masks in the fourth quarter. And Etsy's overall active sellers climbed 62% in 2020, with active buyers up 77%. And then continuing to the first quarter, which is far less pandemic-related spending, the first quarter sales jumped 142%, with active buyers up to 91 million and active sellers up to 4.7 million. So continuing to grow both those active sellers and buyers. So looking ahead, Zacks estimates call for its fiscal 2021 revenue to climb another 32% above last year's massive pandemic-based expansion. And then it's set to jump another 20% higher in 2022 to hit about $2.7 billion. And its adjusted earnings over this stretch are set to climb 9% above what was a huge gain last year, and then another 14% higher in 2022 to about $3.34 per share. The company has also topped their adjusted earnings estimates by an average of 47% in the trailing 4 periods, and Etsy's mixed earnings per share revision activity helps it land a Zacks Rank 3 hold, just like Roku heading into its earnings release. And also like Roku, Wall Street is really high in the stock, with 12 of the 15 brokerage recommendations that Zacks has at the moment coming in at strong buys. Etsy shares have climbed about 80% in the last year to crush the benchmark index in its industry. Wall Street had cooled down on the stock, as they did with many high flyers. And unlike other tech and growth names, Etsy has yet to return to its February records, with its shares up about 1,500% in the past 5 years. And then they jumped about 4%, though, through morning trading on Monday to about $192 a share. And it's now once again back above its 50-day and 200-day moving averages, and it's still sitting right near neutral RSI levels. So this could give it plenty of room to continue to climb, especially if it's able to impress investors with its second quarter earnings results. The company is also trading at a 50% discount to its own year-long highs in terms of forward earnings, and about 35% below when it comes to forward 12-month sales. All that said, investors, just like with Roku and all the stocks we're going to talk about today, you might want to hold off until after the report, because you could see some near-term selling. But if you're a long-term investor, once again, you don't need to be trying to time these plays necessarily. If you're going to be holding Etsy in 5 years, or you're going to remember if you bought it a day before earnings or 5 days after. So especially though with Etsy, it's not sitting at new highs, so it could have more possibility of climbing after earnings, especially if it's able to impress. And it certainly has legs to grow, as we mentioned, especially now that they're acquiring other companies that are in sort of different spaces and even some different geographical areas. So Etsy is certainly worth considering as a longer term buy and hold as they head into their earnings release on Wednesday. And now we're going to end with a company that's set to report their earnings results on Thursday, August 5th, before the market opens, and that is Yeti Holdings, which once again trades under the ticker that is its name, YETI, and it is in the midst of a really impressive run for the high-end cooler company that's continuing to diversify. So we're going to just do a broader overview, as we did with all these stocks, and then jump into some more fundamentals. So the Austin, Texas-based firm began selling its white heavy-duty coolers. I'm sure some of our listeners have seen them either at someone's backyard or somewhere, or now commercials for it all over the place. They can hold ice for literally days. My wife actually bought me a Yeti for Christmas, and we've used it this summer a bunch. And you could, over 4th of July weekend, you put ice in it, and 3 days later there's still ice in it, which is pretty wild, actually. So they began selling heavy duty coolers that could keep ice for days. That was about 15 years ago. And Yeti's journey went from initially sort of helping commercial fishermen and food trucks and countless other outdoor activities that relied on keeping ice cold, into a billion-dollar retailer. And it's really kind of a case study of a combination of functionality and brand building. So they still sell those big heavy-duty coolers that can cost up to $1,300, and they're still found in those commercial fishing boats and people who really have a financial interest in keeping things cold if they don't have a refrigerator. But they've also grown their customer base by having now way more colors beyond that massive white cooler, and they sell different styles and sizes, from hard and soft and just everything under the sun. They sell gear boxes and buckets and outdoor chairs and dog bowls, and any branded offering you can think of, they're not kind of expanding it. But really the star of their portfolio is their drinkware unit, which includes mugs and tumblers and bottles and jugs and various other things that are now accounting for about 60% of total revenue. So they accounted for 60% of revenue in 2020. They've also ventured deeper into the bag market, and they're rolling out more luggage and backpacks and duffels. And Wall Street might start to focus on Yeti's opportunity to compete with the likes of Away and other popular expensive travel bags. So amid all of this, they're now a mainstay everywhere, from boats and trucks and campsites to car cup holders and office desks. And the company's growing stable of products helped its sales soar 20% in 2020 to about 1.1 billion, with direct-to-consumer revenue up 50% to account for nearly half of its sales. So Yeti's direct-to-consumer growth outside of its wholesale business, which is to places like Dick's Sporting Goods and other outdoor-focused retailers, and even places like Target and Walmart and stuff like that, has been helpful. And along with its e-commerce, Yeti has also slowly and strategically built out its brick-and-mortar business. They now have shops in Denver, Charleston, Chicago, and a few other locations. And once again, they've been able to cultivate a pretty cool, hip brand in the social media age. And you know this because they've inspired tons of knockoffs and similar looking products that you can find all over the place, as well as in some of these stores. Yeti is also a part of a group of these newer, higher end brands that are thriving in the Amazon age. This includes the likes of Lululemon and Peloton and sort of those companies that are this new age of retail that's maybe not going to be focused on trying to be in these stores, as they go more for the direct consumer approach. And obviously still a lot of Yeti's business is coming from wholesale as well, but you get my point. Yeti crushed our first quarter 2021 estimates with sales up 42%. So this top line expansion marked its highest as a public firm and came on top of 12% growth in the year ago period. So it wasn't just coming against an easy to compare period last year. Meanwhile, its adjusted earnings skyrocketed 245%, and its gross margins climbed nearly 6% higher to about 59%. And its gross margin sat at just 42% 3 years ago. So they've been continuing to raise their margins, which is really impressive. Yeti's e-commerce segment climbed 60% in the quarter to help boost those margins as well. Plus, its wholesale unit popped about 26% as its products continue to sell through in retail. The company has also invested in modernizing its back end and supply chain efforts, which includes, once again, this is every business, beefed up e-commerce. Importantly, its international space grew at triple digits. Quote, this is from their report, triple digits for the period to reach an all-time high of 9% of net sales, with good momentum across global regions. So growing internationally could be a next big step for Yeti as well. The company is also part of the Zacks leisure and recreation product space that currently sits in the top 8% of over 250 industries. This includes other fellow highly ranked stocks such as Callaway Golf and outdoor-focused retailers. Yeti stock has soared about 95% in the past 12 months to more than double its peers, and this is part of a roughly 475% climb since its public debut. Yeti has cooled off a bit, or had cooled off a bit, I should say, in 2021, but now it's up 45% so far this year. This crushes the market's 17% climb, so that's the S&P 500, and its industry sideways movement. The stock was up last time I checked about 2% through morning trading on Monday, and it touched brand new records of $99 per share. Given this run, the stock is sitting somewhat near overbought RSI levels of 70 at about 65 at the moment. That said, the stock is still trading about 15% below its year-long highs in terms of forward earnings. And Yeti management upped its guidance and prepared to continue to benefit from strong consumer spending. This is highlighted by pent-up demand. We just noticed that consumer sentiment was up big in July, back to those pre-pandemic levels. And especially amid higher income people who can afford to spend $40 in a mug or $300 in a cooler, there is still just that pent-up demand that we could see carrying all the way through the holiday season and on to 2022 and well beyond that. So Zacks estimates are calling for Yeti's 2021 sales to jump 23% to about $1.3 billion, with 2022 set to jump another 14% higher. These estimates would follow 17% growth in 2019 and 20% growth last year. So really highlighting continued strength for a company that went public in the fall of 2018. At the bottom end of the income statement, Yeti's adjusted earnings are projected to climb 17% this year and another 17% in 2022. These growth outlooks could come up well short once again, since the firm has beaten our bottom line estimates by an average of 82% in the trailing 4 periods, including a 73% beat last quarter. Yeti's positive earnings revisions help it grab a Zacks rank number 2 buy at the moment, alongside an A grade for growth in our style score system. And like with all these stocks we've talked about today, 8 of the 14 brokerage recommendations that Zacks has are strong buys, with none below a hold. So Wall Street is remaining really high on Yeti. That's trading once again at new highs heading into its Q2 release on Thursday. So Yeti, as we mentioned, with all of these stocks, could certainly be considered a longer term play heading into its earnings release on Thursday. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.